So good morning, everybody. Thanks for tuning in today to this session on economic inequality in the UK, advances in the measurement of top incomes using tax administrative data. So today there will be 3 presentations. Each of the presentations will last for 20 minutes, followed by 10 minutes of Q&A. If you would like to ask a question, please use the Q&A function, and please don't forget to mention your name and institution. One thing I would like to remind you is that these sessions will be recorded as well. The final remark from my side is that the session will automatically end after 1.5 hours. So I will have to be very strict with time. Let me see. But there is still an opportunity afterwards to ask questions in the conference chat room. So I will now give the word to the first presenters, Matt Greenaway and Dominic Webber from the ONS.
Hi there, thank you, Tahnee. Hopefully you can all hear me. I'm sure I'll find out if you can't. My name's Dominic Webber, and I'm Head of Household Income Analysis at the Office for National Statistics. I'm joined on the presentation today by Matt Greenaway, who is leading a lot of the analysis on using administrative data to support income statistics and labour market statistics at the ONS. And today we're going to be talking about using administrative data to better capture top incomes in official UK inequality statistics. And also to mention Sam Pendleton as well, who did a lot of work for this presentation. So today we're going to talk about the need for adjusting income statistics for top incomes. I'm going to briefly outline a methodology that we've recently implemented in ONS income inequality stats. To adjust the survey under coverage. And then I'm going to hand over to Matt, who's going to talk about more of the ongoing work using administrative data in our stats. So before I go into the nitty-gritty of all of this, I'm just going to briefly set the scene in terms of the statistical landscape for household income stats. And there are 2 primary sources for household income stats. There's the Households Below Average Income series, produced by the Department for Work and Pensions and based off the Family Resources Survey, which is a survey of approximately 19,000 households. And this data set provides the official stats on people living in low income households, or in other words, the official stats on poverty in the UK. And this data set provides a consistent time series from financial year 94-95. And then we have the effects of tax and benefits, and that's a data set that my team produces at the ONS. And this is currently based off the Living Costs and Food Survey, which is a sample of approximately 5,000 households. For the next release covering financial year 1920, we're actually hoping to move to a larger sample, and that will then include hopefully around 17,000 households. The data in ETB is very similar to that in HBI. But we do also look at the further impacts of indirect taxes like VAT and alcohol duties, and also benefits in kind from public services like NHS and education to give a sort of a more holistic view of how tax and benefits redistribute resources. And we also have a consistent time series for this going back to 1977. So now set the scene, I'm going to talk a bit about the top income adjustment. And first, why do we need a top income adjustment in income stats? So there's well-reported issues with measuring top incomes in household finance surveys. The issues stem from a mixture of both underreporting and undercoverage of individuals with top incomes. So the underreporting, basically we think that when we get the very richest people on our surveys, they tend to underreport the amounts of income that they have. And also the number of very rich individuals that we survey, we believe to be an undercount of the true number of very rich people out there in society. And this is an issue that affects household finance surveys in the UK, but also internationally. So we have quite a sort of severe measurement error there. And that obviously has impacts on how we think about the incomes for the very richest people and our understanding of income inequality. And here we can sort of show this graphically. So we use 3 years of data here from the effects tax and benefits. And this is a chart we put together for some research we did a couple of years ago, and that's why we haven't updated for the most recent year, but it's illustrative of the issues that we have. We're comparing here the mean average income reported in survey data with the mean average income reported on tax records, administered data, supplied by the Survey of Personal Incomes, which is a stratified sample of tax records provided by HMRC. And here we compare the mean income across the income distribution from the 90th percentile right through to the end in half percentile brackets. And all three lines track one all the way through to the 97th percentile, which basically tells us that the mean average income reported on survey data is pretty close to that reported on tax data. And at that point, the distribution, this issue of undercoverage of the richest people isn't really an issue. But then from the 97th percentile onwards, we see that line creeping up, 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 and then it goes up quite sharply towards the end. And that basically tells us that the mean income reported on the tax data is getting increasingly higher compared to the survey data. So we're not quite capturing that level of income on our surveys. So that led us to think about designing and implementing a new top income adjustment for ONS stats, working with DWP. And I'm going to talk about that briefly now. So again, just to set the scene slightly here, DWP already have a top income adjustment in place for households below average income, and they've had that in there for quite some time now. World renowned and gets great plaudits in terms of that methodology. And it uses HMRC's Survey of Personal Incomes, which, as I mentioned earlier, is a stratified sample of tax records. And that's why the top income adjustment tends to be known as the SPI adjustment. That's been in place for quite some time. More recently, Burkhouse et al. Researchers explored the current SPI adjustment and looked at possible refinements that could be made to it to improve it. And that sort of led ONS and DWP to explore fresh new approaches for ONS to implement into their income statistics. And as a result, we've now introduced a top income adjustment into our stats at ONS. Next slides now, we'll talk about how the adjustment works. Now, usually when I do these slides, they're a bit more animated, so I click through one by one, and the slide initially isn't presented in such a kind of busy way, but in this kind of format, I have to kind of do it like this, so hopefully it stays clear. So how does it work? Okay, so step one, we rank our ETB and our SPI data by gross income. So the ETB data here is represented by that top bar, the orange bars, and the one below it is the survey of personal income. So we rank everyone in terms from poorest to richest in terms of their gross income. And then we decide upon a threshold and assign a quantile group above which we will adjust at. And the research that ONS and DWP looked at, we explored the impact of a range of different thresholds and a range of different quantile groups to impute at. And but for this example, we picked the 98th percentile, and we impute at 1% quantile groups. So that's the red group and the green group in the SPI distribution there. And then the third step then is to calculate the income boundaries for quantile groups in the SPI. So according to the SPI, to be, and it's sort of made up example, to be above the 99th percentile in gross income, you'd need an income above £140,000. To be above the 98th percentile, you'd need an income greater than £100,000. And then we create bands on our ETB data using these boundaries. So then we give everyone a flag, whether they're above 140 and £100,000 respectively. And what we try to show in this diagram here is when you look at that final, that sort of third distribution at the bottom with the number 2 box in there, that number 2 is much smaller than the equivalent bands in the SPI. And that's to signify that actually we don't have as many people in that box as we should do, according to the SPI data. Click through, please. Yeah. So then the next step is to impute the mean average for each SPR quantile group onto individuals, onto ETB. So that effectively on our survey data, we throw away the information that these people tell us about their incomes and replace everyone with within that band the same mean income that's reported on the SPI. And then we increase the weights of the people in each of those groups so that the total sum of weights within each quantile group is equivalent to that on the survey personal incomes. So that at the end of those 2 steps, everyone above that threshold within those quantile groups will have the same number of people as on the SPI, and they'll have the same average income as everybody on the SPI. But then, of course, by adding more people into those quantile groups, our overall population totals have increased to a higher level than the true population totals. So we re-weight the rest of the data set to the population control total. So everybody else on average has a slight downwards adjustment to their weight, so that afterwards we have a data set with the top incomes adjusted and re-weighted to match the top of the SPI data, and that the whole data set is representative of the UK population. So things to note about that. So to get to that stage, as I mentioned, ONS and DWP worked together for a couple of years to really explore different approaches to this and different adjustments and different sensitivities. And one of the things we determined was actually it is important to impute separately for retard and non-retard individuals. So the HBI adjustment currently does that, and we've done the same thing on ETB because we demonstrate that the issue of undercoverage is one that affects those two population groups separately. And actually, those two groups are really important from an analytical perspective for the users of ETB, and hence we wanted to make sure that we treat those groups correctly. We explored a range of different thresholds and a range of different quantile bands. And the actual sensitivity around them wasn't that great, and the research kind of showed actually the most important thing in terms of any impact is just introducing any kind of adjustment. And actually differences around the 98 for the 96 for having bigger or smaller quantile bands wasn't terribly huge, but nonetheless we centered upon an approach which adjusted above the 97th percentile and in 0.25 quantile bands. So then the main deviation in our approach from HBAI is that our imputation threshold is lower. So we are adjusting more people as a proportion of the data set, and that our imputation is more granular. So the HBAI does one single imputation for one single group, where we split ours into 0.25% quantile bands. The final thing to note is that we rely on the SPI data. Actual full outturn microdata for SPI was not available at the time for 2008-9, 16-17, 17-18, and 18-19. Although now I understand that actually I think maybe some of those data sets are now available. So then we rely on projected data that the HMRC SPI team provide to us. And just to briefly highlight the impact of this, again, I'd normally have a bit of animation to show each one of these series in turn. But the first one to look at there is the bottom blue one, and that's our unadjusted ONS data. And sorry, here we're showing the Gini coefficient, which is a standard measure of income inequality. A higher number means incomes are more unequal, and a lower number means incomes are more equal. So the bottom line there is our unadjusted series, and one of the key takeaways there is income inequality has been broadly stable over the last 10, 15 years. Then the dark blue line there is our Gini coefficient series after an adjustment has been placed, and you can see that income inequality increases, which is no great surprise. We've basically inflated the number of very rich people we have in our data set and generally given them more income. So we would expect observed levels of income inequality to go up. And then next to that, on the yellow line, I mapped the households below average income series. Sorry, I've got that the wrong way around. The yellow line is the top income adjusted ONS series, and the dark blue line is the HBI series. Sorry, but the point here is that while before the adjustment, ONSs and HBI stats, the trends in income inequality were broadly comparable, but as you can see, the levels weren't. Now we've both got comparable trends and comparable levels, which essentially we've made our stats more coherent, which is all for the good. So that comes to the end of my part. Just to talk briefly about some of the next steps. So far, we've only applied the data as far back as, or only applied the adjustment as far back as 2001-2 due to the availability of SPI data. We're aware that there are methods available that others have explored in terms of making this adjustment all the way back to our full-time series back to 1977, and we'd like to explore doing that at some point in the future. And then perhaps more importantly, a lot, this obviously focuses in on the incomes at the very top of the distribution. There's good evidence, DWP, Resolution Foundation are showing good evidence that there's survey under coverage as well, going on at the lower end of the income distribution, particularly people who are reliant on cash benefits. Our survey data tends to undercount the number of people who have benefits, and again, when they do have benefits, we underreport the amount that they get. And that obviously has some really important implications for these stats and the policies that surround them. And it provides a nice segue to talking about the next steps, because I think key to unlocking that next section is, again, more use of admin data. So I'm going to pass over to Matt now, and he's going to talk a bit more about that.
Thanks, Dominic. There are about 5 minutes left now to finish the presentation.
Okay, thank you. So yeah, as Dom says, it's quite an exciting time to be working on household income at the ONS, because we increasingly have access to more and more admin data on income, both on low incomes and broadly on the entire income distribution, in a form which we can link directly to survey data. And there's a lot that we're trying to do with these data, including sort of improving our small area income statistics. But what I want to talk about here is how we want to use these data to better understand the causes of undercoverage of incomes at the top with high incomes in surveys. As Dom kind of mentioned, there's a few, the literature suggests there's a few different things that could be going on here to kind of cause this undercoverage at top incomes. So there's unit non-response bias, so perhaps high earners aren't responding to surveys, or perhaps there's kind of item non-response, so perhaps individuals are responding to surveys, but kind of we're missing some components of their income, or perhaps just underreporting of income for higher earners across the board. And in reality, it's likely to be a mixture of these things, but the point is we want to understand what that mixture is in order to better understand how we can develop our kind of our top income adjustment that Dom's just talked through. And I'm going to talk a very little bit now about how we've tried to start doing that with HMRC's self-assessment data. So I mentioned that non-response bias, so perhaps high income individuals just aren't responding to surveys. So what we set out to try and do is calculate essentially a response rate, an LCF survey response rate by income. And I have to put a very heavy caveat on this, because we have so far only been able to do this with self-assessment data. Not everyone completes a self-assessment return, so that kind of limits what we've been able to do here and the robustness of the results, and we want to repeat it using income from more sources. But having said that, what we can see here, there's a graph there of what we think the response rate is by different income bands. And there's maybe a little bit of evidence that the various highest earners here have a somewhat lower response rate. But it is, as I say, quite limited evidence. And I'm essentially just showing this to demonstrate the kind of work that we are doing and that we want to develop. So yeah, perhaps a little bit of evidence there of unit one response bias, but perhaps unlikely to be the full story. And then, of course, there's this idea of item non-response. So perhaps some components of income, perhaps that are particularly prevalent amongst high earners, aren't captured well on the survey, people that are kind of not responding to those questions, or perhaps there's kind of underreporting across the board for high earners. They just kind of want to rush through the questionnaire, perhaps, and that kind of thing. So what we want to do here is kind of, for our linked data, compare total income from admin data and survey data. We haven't quite been able to do that yet because we haven't quite had the data to construct a total income measure in our admin data that we've been able to link to survey data. But what we have been able to do is focus in more on self-employment income, which we do have a complete picture of from the self-assessment data, at least in tax terms. And the idea here is that perhaps if you can look at kind of compare survey and admin data for linked individuals component by component, then you can start to build up a picture there. So the sort of the research question here is for self-employment income, is there evidence that, particularly for high income individuals, they are reporting underreporting their income on a survey as compared to self-assessment admin data? And actually what we found is the opposite, that actually more or less across the board, actually, high income individuals are reporting larger values for self-employment income in the survey than they do in their self-assessment returns, even though actually in the survey we ask them to refer to their self-assessment returns and refer to a particular figure. So we think there's quite a lot going on here. There's a few different hypotheses we're investigating. A key one, well, a couple of key ones are that I mean, tax evasion and avoidance are kind of perhaps an issue on the admin data side. Then on the survey side, actually 60% of individuals don't actually refer to any documentation when they're telling us about their self-employment income. So there's a hypothesis that perhaps if you're doing that, you might omit to. So what we want is net income, net of expenses. So we might fail to kind of account for some expenses and perhaps report something closer to a turnover figure when responding to the survey. We can see some evidence of that in the linked self-assessment survey data. But the headline here is that we can't see any evidence of underreporting of top incomes being caused, particularly by self-employment income at least. One thing that is actually quite striking when we look at kind of the self-assessment data as a whole and the survey data as a whole is that if you look at the very largest values, particularly for self-employment for things like partners in industries like financial services and law, the largest values in the self-assessment value data are kind of orders of magnitude larger than the largest values you get in the survey. And of course, this is what you'd expect because the survey is a relatively small sample, and with self-assessment data, you've got the entire population. But it's still, and so that's not in itself going to cause a kind of misrepresentation of the entire distribution in the survey. But I think what it does demonstrate is that actually top incomes, it's a rare event, having a very high income, and surveys aren't great at capturing rare events. And actually perhaps there's scope here for using administrative data to improve our survey sampling, which is relatively hard to do, but perhaps there's an opportunity to get more higher earners in our surveys via use of linked administrative data to our sampling frames. So there's a lot more I could talk about, but I should just try and summarize all of this. So Dom's talked about how, okay, we have this well-reported issue that survey data underreports and has undercoverage of individuals with top incomes, and how we have a top income adjustment now which utilizes aggregate SPI data to fix this. And I've just kind of tried to touch on briefly how we want to continue to develop this, and we think in order to do this we need to understand basically the mechanisms, what's happening, why are we getting this underreporting of top incomes and the coverage of top incomes, what's the balance between non-response and measurement error and item non-response. And we're using linked survey admin data to try and do this, and the eventual aim obviously being to utilize survey and admin data together to get the best possible estimate.
Thank you, Matt. I will have to cut you short here for the Q&A, but thank you both very much for these interesting talks. If you have questions, could you please use the Q&A box, and don't forget to mention your name and affiliation, please. So right now the chat box is still empty. The Q&A box, I will wait a few more seconds, otherwise I will give the word to the next presenter.
Can I chime in with a question? It doesn't let me use, this is Arun Advani, one of the future presenters, but it doesn't let me use the Q&A because I'm in the room. I was going to ask what, when we think about income here, what kind of concept of income effectively are we targeting? So I mean, we've talked a bit about this before, but I guess what's measured on tax forms is taxable income specifically, which doesn't represent all of the income that people have. So to the extent that these things are being used to measure inequality, they sort of necessarily miss a bunch of things that we would think of as income in the sense that they generate welfare and they're money that people can spend, but they're not taxable. And I just wonder whether when you kind of link to the SPI, which is very clearly focused on something that's a concept of taxable income, whether that's sort of the right measure for what you want. It might still be an improvement, but whether that's another limitation you need to think about.
Dom, do you want to cover that offline?
Yeah, that's absolutely fine. I can cover that. So I think if I'm answering your question correctly, you're asking, are we considering the right measure of income here to adjust that? And I totally appreciate the arguments. Actually, there's there's more measures out there that can actually be considered as income that we might not be considering at this stage. I mean, at the moment, we tend to follow international standards and guidance on this in terms of as what constitutes as income in terms of that regular amount. But, you know, we're also considering, especially the work that you've been leading on, Arun, in terms of alternative sources and other things and how we can supplement or those kind of measures into our income stats.
So thanks for that answer. I see one question now in the Q&A from Ria from the Central Bank of Ireland. Is it possible to unmute?
Yeah, can you hear me now?
Yes, thanks.
Yeah, thanks very much. This is Ray Lydon from the Central Bank of Ireland. That's a really interesting presentation. I assume you're probably in touch with my colleagues in our Central Statistics Office who are doing quite similar things, and also COVID seems to have sped a lot of that work up in terms of linking the survey and the admin data on incomes. My question is about regions. Is there a regional dimension to the top level adjustment? Is it something you're exploring? I would expect there probably is a north-south element, but maybe you can answer.
So Dom, I think you might be on mute if you're trying to talk.
Sorry, yeah, I was on mute. we built the adjustment off the back of the DWP adjustment, and in there they impute separately for Northern Ireland and the rest of UK residents, yeah. And we explored that, and we to understand whether that was necessarily justified, and we couldn't find much evidence that within those regions there was much need to do that. But I can imagine, if you're able to look at things, more granularly, there could well be. But then you come across the problem where your sample sizes are so low. You kind of need a decent sample size when you're cutting your data up into that finer groups. If you're trying to then break it up into regions, you start running into problems. So so at this stage, we're not thinking about doing anything regionally. But if we thought there was a good reason to, then we would certainly look at that.
Okay, thanks.
So thanks very much. I don't see any questions anymore in the chat box, so I will move to the next presenter. So thank you for this presentation again and for the questions. The slides are stopped sharing, great. So the next presenter will be Lorenzo Pessina from Columbia University.
All right. Hi, everyone. Let me share my screen in full screen. There we go. All right, awesome. Thanks for the organizer for putting together this great session. I'm Lorenzo Pessina. I'm a PhD candidate in economics at Columbia, and I'm on the job market this year. Today, I'm going to present joint work with Arun Advani at Warwick, Felix, Koenig at Carnegie Mellon, and Andy Summers at LSE. Before starting, let me just mention that the usual disclaimer applies with this type of data. All right. So top incomes. So there's a vast. Let me jump in by starting with saying that there's a large literature in economics that shows that top incomes play a key role in entrepreneurship and innovation, economic growth, and also at the macroeconomic level in aggregate demand and savings. And top incomes have been shown to be key in the analysis to the response, of the response to taxation. Moreover, recent work has also studied the characteristics of individuals at the top of the income distribution. However, this work has been unable to distinguish between natives and migrant, a distinction that we are going to show today that it is quite relevant to understand the trends in economic inequality in the UK over the past 2 decades. Another strand of literature has showed that high-skilled migrants have contributed a lot to innovation, entrepreneurship, and growth. And moreover, the threat of migration affects top incomes across countries. Therefore, migrants could alter the composition of individuals at the top of the income distribution. And so little is known, there's little evidence on the effect of high-skilled migration on inequality in the receiving countries. We try to link the high-skilled migration and inequality by answering two empirical research questions. First, we asked to what extent migrants altered the composition of individuals at the top of the income distribution in the UK. And second, we asked how much foreigners accounted for the increase in income inequality over the past 2 decades. And before continuing, I just want to mention that throughout the talk today, I'm going to use the terms migrants and foreigners interchangeably. So what do we do in this paper? We combine administrative data on the universe of taxpayers within the top 1% of the income distribution and a novel strategy to identify migrants in those tax records. Let me, once we do that, we provide 3 novel findings. First, we show that migrants are very prevalent at the top of the income distribution. This is shown in the next picture. You can immediately see that the top of the income distribution clearly stands out. This graph shows the proportion of migrants at each percentile of the income distribution. And the red dot represents the top percentile of the income distribution. And it shows that almost a quarter of individuals at the very top of the income distribution are migrants. Then we also show that earnings have pushed migrants to the top. And earnings as opposed to passive investment income. So we find that actually it is earnings of migrants that are driving these trends. And finally, in the spirit of the growth accounting literature, we find that migrants account for around 85% of the increase in top income, the top 1% share in the UK over the past 2 decades. So a really large proportion. Let me go over the data section of this presentation. Our presentation our empirical contribution rests on accessing administrative data from HMRC. And therefore, as I mentioned, we use the universe of individuals within the top 1% from 1997 to 2018. And we make use of tax returns and payroll records. As this is a conference about measurement and economic measurement, we want to be precise of what we're measuring. And so we use, as our definition of income, we use pre-tax fiscal income. We also make use, and we're going to split that in some exercise in some part of the paper in between earnings and investment income. And then we also make use of the usual control totals for income and population that are common for the inequality literature. Then we also we need to also define a migrant. And we do that by identifying as migrant any individual who migrated to the UK after the age of 18. To do that, we exploit the structure of the national insurance number, the NINO. In particular, we use the first 2 letters of the NINO that corresponds to a date range when the NINO was assigned to the individual. And we use archival records to create a novel correspondence between the year of assignment and the first two letters of the NINO. After we do that, we are able to cover all years and all the NINOs assigned since national insurance was created in the UK after World War II. And this gives you a quick snapshot of the types of archival sources that we make use of in our paper. On the left-hand side, you can actually see kind of at the top of the figure the structure of the NINO, which has remained constant throughout the period, which has remained constant since World War II, and allows us, therefore, to exploit these first two letters of the NINO. To identify migrants in our tax data, in administrative data, we exploit the fact that all UK children are assigned a NINO at the age of 18, whereas migrants need to apply for a NINO when they come to the UK through a separate adult registration process. And to identify migrants, we therefore compare the year of birth of an individual and the year of assignment of a NINO. And we define, again, as I said, we define anyone who received a NINO at the age of 18 or older is a migrant. And this is a conservative definition to kind of avoid, to minimize false positive instead of, and that's the reason why we don't pick the age, the age of 18. So we have this buffer, this 2-year buffer to minimize false positive and in our data. All right, let me move to the results, the empirical results of the paper. So let me first start by the first empirical result is that we see that migrants are really prevalent at the top of the income distribution. So this is part of the graph that I showed earlier. It is truncated at the 97th percentile because it is the this would be the picture if available sources, if the current publicly available sources were used to calculate and quantify the prevalence of migrants throughout the income distribution. And the sources that the data sources that I'm referring to are survey data for the UK. So as I mentioned, the picture is truncated at the 97th percentile. You can see that actually the average share of migrants throughout the distribution is around 15%. That's the red dashed line. And another important aspect of this picture is that migrants appear to be concentrated at the bottom of the distribution. You can see that indeed there are more migrants relative to the average throughout the distribution at the bottom of the distribution. And this is where much of the public debate and the academic literature has focused when analyzing and talking about migration. However, our empirical contribution that combines administrative data on the universe of individuals at the very top of the distribution and a novel strategy to identify migrants in tax records allows us to show the entire distribution. Then when you can see the entire distribution, the top clearly stands out. It is the top that stands out. And you immediately see that there are almost a quarter of individuals in the very top percentile of the income distribution are migrants. And in particular, there are 1.4 times more migrants in the top 1% than in the bottom 10% of the distribution. If we zoom in the top decile, we can actually see that there is quite a lot of heterogeneity even in the top percentile. So you can see that the proportion of migrants rises gently from the 90th percentile of the income distribution, but it is at the very top that migrants appear to be concentrated, with more than a third of individuals in the top 0.01% that are migrants. And when to give you as a reference point, when I'm talking about the top 0.01%, I refer this corresponds to around 5,000 individuals in the UK. Now, this was the picture in a cross section. Here we show the evolution we show the trend over the 2 decades that we obtain access, for which we obtain access to the data. So since 1997 to 2008, migrants obtain an increasing share of the top income. And in particular, the migrants' share of top income has increased by more than 50%. In the paper, we decompose this increase, this trend, into whether this increase was coming, to try to understand whether this increase is coming from an increase in the number of migrants as opposed to an increase in the average income of migrants relative to natives. And we do show that actually the trend is largely driven by an increase in the number of migrants rather than an increase in the average income of migrants relative to natives, suggesting that migrants are becoming more and more prevalent at the very top, and there is a continuous demand for high-paying jobs that migrants are fulfilling without any downward effect on their income that they're receiving on average. Let me move to the second set of results, where we show that actually it is earnings that are pushing migrants at the top. When you see these graphs that I just showed you, you could ask yourself a question of what migrants are doing when they come to the UK. And indeed, one might think that these migrants are already migrating to the UK very rich. For example, there are well-known example of this type of migrants, very rich migrants to the UK, such as Roman Abramovich or the CEO of ArcelorMittal. They moved to the UK with being already rich, and one could wonder whether they're just moving to the UK and enjoying their income from assets held abroad. We show that actually this is not the case for the majority of migrants. While for sure these type of cases exist, they're not the majority. And indeed, the trend has been the trend that I showed you before is really pushed by migrants' earnings. This is true.
Lorenzo.
Okay, perfect. Now, if we look at the industry composition, so where these migrants are working, we find in the paper that finance is that many migrants work in finance and in financial sector, broadly defined. So more than 30% of top 1% migrants work in finance as C-level or mid-level managers. Therefore, they are really active participants in the UK labor force, even at the very top of the income distribution. And to give you another piece of evidence that these migrants are positively selected, we calculated the distribution, the age distribution of migrants at the top. And you can see that migrants joined the top 1% at a younger age than natives. Then in the last part of the presentation, let me go over the third set of results. We, in the spirit of the growth accounting literature, we try to account how much migrants are contributing to the increase in the top share in the UK. To do that, we decompose the top share into a native and a migrant share, and we decompose also the growth rate. The top one share increased by 2 percentage points to 14.3% in the UK since 1997. This is a 15% increase. We calculate that migrants account for 85% of it. So a really large chunk of this increase is accounted for by migrants. Now, we want to be very clear that this is not pointing to a causal evidence or a causal effect of migrants on income inequality, as we do not have a counterfactual for the situation to describe the UK without migration. Yet, this growth accounting exercise wants to quantify the contribution of migrants to the trend in income inequality. And so this picture shows the time series of this contribution. And you can see that migrants, the red line, which shows the contribution of migrants to the increase in top income inequality, has been constantly increasing over the past 2 decades. While there are 2 clear periods in the trend in income inequality in the UK. First, before the financial crisis, we see an increase in income inequality that is marked by the dark blue line. And then the top share has remained rather flat in the UK overall after the financial crisis. But you can see that instead, the contribution of migrants have increased throughout and constantly over these periods through booms and busts in periods of economic expansions and contractions. And so this shows you the overall effect for this decomposition for the top 1% and for finer fractals as well. All right, let me conclude by just summarizing the effects that the results that we showed in our paper. We showed that migrants are overrepresented at the top of the income distribution, and that earnings have pushed migrants at the top. Therefore, we show that the composition of individuals at the top of the income distribution has really changed over the 2 decades and has skewed and is now more skewed towards migrants. We also find that migrants account for a large share of the increase in the top one share in the UK since 1997. Now, these results are quite important and are quite relevant for policymakers as well, as the composition of individuals at the top has changed. The response of individuals at the top to, for example, tax policies might also have changed as well. In particular, both in terms of the response of individuals to tax changes in terms of their income, but also the migration response of individuals at the top might also have changed in light of these results that show that the composition of individuals at the top is now more skewed towards migrants in the UK. And with that, I conclude. Thank you. And I look forward to your questions.
Thank you, Lorenzo, for this presentation and co-authors. Really great work. I would like to ask the audience, if you have any questions, please type your name and institution in the Q&A box. I don't see any questions right now, so I will give it a few seconds. So there's one question coming in now from Peter Level from the Institute for Fiscal Studies. And after that, we will take again a question from Reeve from the Central Bank of Ireland. If the host can unmute
Okay.
these attendees, please.
I've been unmuted. Okay. Thanks very much. Thanks very much, Lorenzo. That was a really clear presentation. I was wondering if one of the things you're able to do with your data is to look at different cohorts of migrants. People who arrived at the UK at a given age in a given year, and just, over time, how has the progression of migrants changed from cohort to cohort? So is it the case that the people hitting the top 1%, that they arrived in a different period from people earlier? I'm just wondering if that's would be an interesting thing to look at.
Yes. So thanks a lot for your questions. For your question, that's a great question. So we do look a little bit at that. So we look at, for example, when we take the base year, for example, when we look at migrant, or like we look at the individuals at the top in recent years, we look at, in the paper we show when they arrived to the UK. We do find that a large 1 in 6, so around like 15-16% of migrants that join the top 1% in any given year has arrived within the previous 2 years in the UK. So this suggests that, and 1/3, and this proportion becomes 1/3 if you look at the past 5 years, suggesting that a large chunk of migrants arrive to the UK with a very high earnings potential. And then we do find that there is a whole distribution of year of arrivals going back to the 80s. We haven't looked at much at the different cohorts, but that's certainly something that we could do, and we are looking into. We definitely see a pickup in the rate of arrival, in the rate of arrival of migrants that eventually make it to the top 1% in the late 90s, early 2000. But that's definitely something that that we want to investigate more.
Thank you very much.
Thank you.
Hi, Lorenzo. Can you hear me?
Yes, perfect.
Yeah, this is Ray Leiden from the Central Bank of Ireland. Just to echo what Peter said there, really nice talk and interesting work. I have a couple of comments or questions. So first of all, would you venture, what do you think is the key policy message from this part of your work? I know you do other work. So would you care to venture kind of your opinion on that? That's number one. Second, I think there is really interesting scope here for a cross-country study, just on the monitoring or the stylized facts element of a lot of this. And I think, like the question I asked the first speaker, other countries should be able to do this sort of stuff. I know some countries in Europe, I know Ireland can do it. And I could put you in touch with the people on that if we want to talk by email after. And that would be very interesting. The last part is a bit like your answer to Peter's point on my final comment. Is there a sector effect here? Is a lot of this the city? Is it finance? That sort of thing. Have you looked into that?
Yes. So, well, thanks a lot for your questions. Let me start with the second one about cross-country comparison. Yes, we definitely think that this type of work could and should be done in other countries, and because indeed we do mention in the paper that, and there is data out there that shows that high-skill migration is concentrated in the UK, but not only in the UK. So I'm thinking about the US, Canada, Australia. These Anglo-Saxon countries have been a magnet for high-skill migration in the past 2-3 decades, and therefore it would be great to have access to this type of data and to quantify this in for other countries. You mentioned Ireland, probably Ireland with Dublin. The trend is probably more recent, but I'm sure we'll probably I'm sure there's going to be interesting finding for Ireland as well if you have access to this type of data. So absolutely. Then when you look at cross country, certainly each country has its own specificities in terms of the economy and what is the sector that is really attracting these high-skilled migrants. We mentioned in the paper and in the presentation, finance for the UK is certainly a sector that attracts a lot of high-skilled migrants from overseas to the UK. You can think about tech in the US, and so there's work in the economic literature that shows that really the Silicon Valley is a magnet destination for high-skilled migrants.
Yeah.
Now, this kind of like segue to your first question about policy implication. We don't want to venture much into policy implication because this is kind of descriptive work, but it clearly shows that certain sectors benefit from high-skilled migration, and therefore the latest nativist policies that are implemented in the US and in the UK might actually hinder, or have the objective to kind of like hinder the flows of migration. And you can think that some of the sectors that rely on high-skilled migrants could not benefit, but they could certainly take a hit in a sense if the transition costs are quite high. But again, this is kind of like speculation, and we're certainly interested in doing more work with our data set in the future to kind of quantify more precisely and give a more precise and a better answer at the question of the benefits and costs for the economy that stem from these high-skilled migrants.
Mm-hmm. Yeah, thanks, Lorenzo. Maybe we'll touch base by email after. That's
absolutely.
Very interesting.
It would be great. Thank you.
All right, thank you.
Okay, well, thank you very much again to the presenter and the people asking questions for this great second presentation. So now we will continue with the last presentation of this session, which will be held by Arun Advani from the University of Warwick, and he will be talking about capital gains measurement in UK inequality statistics.
Great, thanks very much, Tahnee. So as Tahnee said, we're talking about capital gains and UK inequality. This is work co-authored with Andy Summers, who's at the LSE. Again, like the last presentation, so it's great to be following Lorenzo, we'll be using data from HMRC, the UK Tax Authority, and so I have to show you the mandatory disclaimer that nothing I say represents their views. And so we're motivated to look at this work because we know that top incomes are very sensitive to tax incentives. So for example, work both in the US and the UK shows how responsive people are at the top in terms of repackaging their income, sort of making labour income look more like capital income, like dividends effectively, because dividends are typically taxed at a lower rate. And there are even larger incentives, in fact, to switch rather than from labour income to dividend, capital income, to switch to capital gains. So to have, to try to move returns into the form where you have an asset that's increasing in value. For example, if I put money into if I get money into my business, rather than paying that money out to myself as dividends, if I can keep the money in a business and later either sell the business or liquidate the business, take the returns in the form of capital gains because the value of the business has risen. There's sort of much larger returns to doing that because capital gains are taxed at even lower rates than dividends are. And that's actually why economists regularly call for the equalization of tax rates between incomes and capital gains. And it's probably part of the motivation for the current review of capital gains in the UK. So this kind of ties with the question I actually asked in the first presentation, which is, gains are one of the things that are not included in standard measures of fiscal income. I mean, gains are not fiscal income. They are treated as a separate type of return. They're, to the extent that when I get them, they are cash that I can spend. They are valuable to me, but they're not measured as part of fiscal income. And that means they're not measured in our usual measures of inequality that are based typically on fiscal income. And that's important, not only because it changes sort of where people's money comes from. So recent work that's been thinking about is, do the rich, for some definition of rich, get their money from labor income or sort of passively from investment income? It's not just about that kind of split. It also changes who's at the top, because the recent work that's been trying to say how much of labor income has actually been changed in the form of capital income still relies on that set of people at the top being the right set of people. Whereas capital gains, because they're excluded, might mean that there are people who have gains who are just not being captured at the top of the distribution, even though they have high returns. And so it misses out who's at the top. It also changes what share of all remuneration goes to people at the top. And so the question for our paper is, how do capital gains change our picture of inequality? How should we think about inequality differently if one were to think that capital gains were worth including? And our kind of key headline results that I'll focus on for today are, firstly, that gains really largely are shifted income. So to the extent that one of the open questions is, if gains are really a very different kind of return to income, maybe we don't want to include it. I'll show you that more than half of all gains are really what we might think of as returns to human capital. So really they're labor income that's been moved into the form of gains. And so that's important because that really ties in with, it becomes hard then to see why you want to treat them very differently to other forms of things that are captured by fiscal income. Administratively we capture them separately, but even if they're going to be separate on an administrative standpoint, when we think about inequality, we probably want to be putting them together. Then I'll show you that when we include gains, it changes who's at the top. So we'll get more business owners at the top, which is sort of not surprising because ownership of business is one of the ways in which you can transform income that you have into capital gains. We'll also see more women at the top, and we'll see more older people. And then finally, I'll show you that including gains raises the level of top share inequality. Both just kind of across the board, it's raising the level. It'll also change the trend of top share inequality. It's actually been rising over the past 20 years rather than being relatively flat for the 1%, as you might have thought if you sort of had followed the discussion of what's been happening to fiscal incomes. So the data I won't spend a lot of time on because Lorenzo's already largely covered these. So these are the administrative data from HMRC on all self-assessment tax returns for the last 20 years. We have information for individuals on their incomes as well as their capital gains. We can actually link this stuff up to PAYE records as well. I haven't spent time kind of explaining the details of that here, but we can capture that as well. But since our focus is really on the, will be on the top of the distribution, and the self-assessment starts at £100,000. In principle, everyone who is in the 1% is already captured in the self-assessment returns. One kind of big caveat that I should mention at this point is that when we talk about capital gains, what we will observe are taxable capital gains, and that's clearly not all capital gains. So the biggest exclusion there will be main homes. So if you own a property at the moment that you live in, and it's your main home, when you sell it, you don't pay capital gains on it. You benefit from principal private residence relief. That's important because those kind of gains are probably going to bring down what we think of as our estimate of the amount of money that goes to the very, very top. Because if you were to include those gains, those obviously ownership of homes is not concentrated only at the very top. So that would probably bring those numbers down. They're also the kind of, ownership of a home is probably the kind of gain that you might think of as most different to income. I mean, one of the reasons I think people sometimes want to keep gains and income separately is this sort of, I bought a house and it increased in value and I sold it, but I wanted to buy another house with the money anyway. Means that people don't really feel like the returns from a home are much like income. And I think that's quite a reasonable position to take. But the kind of stuff that's captured by taxable capital gains, which is, you know, a second home that I might own, or additional properties that I'm renting to people, or businesses that I own, those feel like things that might be closer to income. So there might be a good principled reason anyway for keeping them separately, but I should mention that they're separate. We also miss transfers on death. So if I die with any assets that I've gained in value, those gains are written off on my death, so that those gains don't have to be reported and won't be taxed. So we won't see them. Similarly, we won't see transfers to spouses or to charities. And we observe a bunch of standard taxpayer characteristics, so age, gender, geography, some of which I'll use to show you some of the breakdown today. So the first, and I think for me, the most striking result is that gains are incredibly concentrated. So what I've got on this graph here is from left to right, we've ranked people who have gains above £100,000 in a particular tax year. This is 2017, but you get very similar results if you take a different tax year. So we've ranked the people above £100,000 in capital gains. So 54,000 people who look like that. So that's about 0.1% of the adult population. So 0.1% of the adult population are represented here. And that, even though it's only 0.1% of the adult population, 95% of all gains are already on this graph by value. Taxable gains are on this graph by value. So 0.1% of the population get 95% of all taxable capital gains. But even within this 0.1%, gains are still incredibly concentrated. If you go just to the top 5 bars, so these bars are 1,000 people at a time, ranked from the highest capital gains on the right to the lowest capital gains on the left. Those top 5 bars, which are the top 5,000 people, or the top 0.01% of the population, get more than half of all taxable gains in the economy. So just, you know, to give you some context for that, the 0.01% take home about 2% of all taxable income. And so one might really think, well, that's relatively concentrated. You know, they're 0.01% of the population, but they're getting 2% of income. They're getting 54% of all taxable gains. So this is kind of an important issue for us to be thinking about. It's really going to affect the way we think about inequality, because capital gains are much more concentrated than something like income, which, you know, most adults will have some income. And so you can see that kind of rightmost bar is this, you know, people who with an average gain of £14 million in a single year. Minimum gain to be in that top 1,000 people is about £7 million. So it's incredible concentration here. So you might then want to think, well, where are these gains coming from? What are they in respect of? And so what this graph is doing is just to show you the same bars I showed you a moment ago, but now breaking it down into a bunch of different categories. So the biggest group is the group that's unhelpfully labeled other assets, this kind of gray area. Now, other assets in principle can include all kinds of complicated and fancy stuff. But for them, and these categorizations here are based on the tax form. But for the most part, what these other assets represent are capital gains that are covered by a particular relief called entrepreneur's relief. And so entrepreneur's relief until March was allowing people to take home up to £10 million in capital gains at a tax rate of 10%. That's £10 million over their lifetime. And so what you're seeing in these kind of grey bars, for the most part, is people who are selling off their business or parts of their business and realizing gains, and those gains are being covered by entrepreneur's relief, and so they come into the other assets category. That kind of greeny area of unlisted shares is, for the most part, the rest of those businesses where people have hit their £10 million cap for entrepreneur's relief, or for some reason weren't eligible for entrepreneur's relief. But at the very top, it's mainly people who are just exceeding the £10 million cap. So these are other gains that people are making on their own businesses. And so when we see people making these kind of gains on their own businesses, that feels quite a lot like something you might otherwise want to think about as income that they're kind of getting from the work they're doing in their business, rather than something that looks like a very fundamentally different kind of asset. What people tend to think about, as I said earlier, when you sort of talk to people about anyone who has any idea about capital gains, most people probably have no idea what they are. But when I've talked to people about gains, the question I always get kind of started with is, you know, but aren't these gains just people, you know, selling a second home or something? So that yellow area that you can almost not at all see, but you can see it about in the top bar, but everywhere else it's pretty small, is residential properties. Those are the sales of second homes. They do exist, but they're pretty small in terms of aggregate value. They're actually in same size in total aggregate value, they're about as valuable as the dark blue carried interest. And carried interest is sort of something that's clearly the returns to labour income, although it's taxed as capital income. It's a special privilege that you get if you are working in private equity or other kinds of asset management, where your fund can pay you returns, even though you have no capital at risk, can pay you the returns based on your labour income in the form of carried interest, which allows them to pay you at a lower tax rate. And so, from looking at this, this strikes us as, a lot of returns are from business activities. Some of them are from other kinds of labour activities, such as carried interest. So these are things that probably we at least think, ought to be really included in what we think about as a sensible measure of income. So if we were to include them, what does that do to our measures? So if you take into account gains, the first thing I want to show you is that the rich are older. So here, what this bar that you can currently see described as stayers shows you the age distribution of people who are in the 1% when you rank people from richest to poorest by fiscal income, our usual measure. You rank people up, and you take the top 500,000 roughly people. Those are the people who have the highest fiscal incomes. Stayers are the people who are in that top group and are also in the top 1%. If instead of ranking people on income, you take people with income and capital gains and you rank them. So people who are at the top and who are still at the top when you account for capital gains are in this stayer group. And what you can see is that these people are, for a broad definition of young, relatively young. So more than half of people are below 50, 4 out of 5 are below 60. This is broadly a kind of youngish working age type crowd. Leavers are the set of people who are at the top when you rank people on incomes. They're no longer at the top 1% when you rank people on income plus capital gains. And broadly, they have a kind of similar age distribution. So the people who you're kind of knocking out when you account for capital gains look quite similar to the people who remain. But the joiners, that is the people who are at the top when you include capital gains, but who were not at the top before, are much older. So you can see that 20% of them are above 70, about half of them are above 60. So sort of completely reversing what we saw before. This is a much older crowd. 3/4 are above 50. There's a very, very different distribution in terms of the age. In one sense, that's not surprising. To be able to realize a lot of capital gains, you probably have assets that you've either held for a long time or you've been kind of putting money in, getting money into if it's a business for a long time. And so you'd expect it to be people who've been around longer and who therefore have the ability to do that. And so even the people who I was describing earlier as sort of having businesses that they're later liquidating, they often will do that on retirement. And so you expect to see people who are kind of towards the retirement type ages. They're also more likely to be female. So again, this is not an equal distribution in the sense that joiners are still more male than they are female, but relative to the 4 out of 5 people at the top on income only being male, having 3 out of 5, only 3 out of 5 being male is sort of an improvement in that sense. I don't think we can yet think about this as sort of a big win for female empowerment. It's a bit hard to know how to read some of these results. In the UK tax system, we, for the most part, tax incomes separately between husbands and wives since the last sort of 30 years. And what that means is you can't easily link people up within the household, although I know the ONS is doing exciting work trying to effectively linking up individuals within households. So we can't see with these gains, given that we know that women in general have lower incomes over their lifetimes, one possibility is that women have lower incomes, but they still anyway are saving more and therefore are able to buy assets that increase in value. But other possible interpretations that make us sort of cautious about thinking of this as a big win for women is that one thing we know that happens is if I have an asset, if I have some shares, for example, that are receiving dividend income, I could maximize the personal allowance against which we kind of get a lower dividend amount of tax we pay on dividends if I split the shares between me and my wife. Transferring to my spouse doesn't incur capital gains tax, and by doing that we can benefit in life from, or in the kind of ownership period, from both of us having the right to get some income tax free. What that means though is that when it comes to selling those assets, I may have bought them, my wife is the one who's selling them, and so more of these gains are sort of included against her. The other thing is that because we know that a lot of these women are on the older side, there's a good chance that some of them will be spouses where husbands had assets. I mean, the wives probably had some assets as well, husbands had assets. When they died, they got passed to the wife, who tends to live longer. And so because there's no capital gains tax charge at that point, it's later when we see the women selling that we see these gains being included.
5 minutes, Arun.
Yeah, perfect. And finally, these individuals are much more likely to be business owners. So I kind of highlighted this already a bit. But what you can see is that these are people who are, firstly, they're compared to stayers and leavers. The joiners are much less likely to be employees. They're much less likely to be reliant mainly on labour income. So employees here we define as people whose main source of income is employment income. Similarly, self-employed are those with main source of income is self-employment. And again, so those groups are relatively small. Pensioners are a much larger group here. So pensioners are still not, at all the majority of the top, but among those people at the top who are pensioners, you can among those people who get to the top, the pensions are really brought in by capital gains effectively. And something similar is true for investors. So investors actually don't look like they're that far up the distribution when you account only investment income. When you account for the fact they're also getting gains as well as dividend income, you see many more of them at the top. So these are a few of the stylized facts we pick out. But I think the key thing is that when we account for capital gains, it changes the kind of people we see as being at the top. And that's kind of important in the way that we should think about what's going on and when we should measure these things. So what does that do to also our share of income that goes to the top? So these are kind of the standard pictures you might see if you're used to fiscal income. What share of all income goes to the top 1% or 0.1 or 0.01? So the top 1%, we're used to thinking of about 14% of the income goes to that top group. If you account for the fact that there are also capital gains, so you keep the same group of people at the top 1%, you're not going to change who's at the top, but we just account for the fact they may also have capital gains. You see that increases the amount of gains by about 1.5 percentage. The share of total remuneration that goes to that 1% group by about 1.5 percentage points. If you also re-rank to account for the fact that there are some people who are now at the top when you include gains who were not at the top before, this increases to almost 17%. So you're having about as much effect again. When you look at the smaller groups, so say the 0.01 on the far right of this graph, most of the effect is not really about adding in capital gains for the existing people. It's really about bringing in a new kind of person who is high in capital gains but doesn't have much, relatively speaking, in terms of income. So if you take those blue and those red bars that I'm showing you here, so the top 1% share by income only and the top 1% share by income plus capital gains ranked on income plus capital gains. These are the numbers for 2017. To get a sense of what this does for the trend, we're now going to look at those things and how they look over time. So the blue and the red are defined exactly as before, but now I'm showing you not just the 2017 bar, but rolling forward a year and also rolling all the way back. So what you can see on income only is that the trend has been relatively flat. There's a slight increase over the last 20 years by almost a percentage point. When you look on including capital gains, firstly, the level is higher, but also in contrast to sort of the story that we had that we were all in it together over the crisis and the top weren't getting better off. If you take into account capital gains, there is a larger rise. Now, one thing is the capital gains line here is much more varied. It's more sensitive to policy in some ways because people will realize a lot of gains. So that spike in 2008 is caused by the ending of taper relief. So what we can do is move to an accruals type series rather than a realized gain series. And here what you see is sort of broadly the same trend, but you lose a lot of the volatility and the level is slightly higher at the start. So that increase is slightly muted relative to the realized gain series. But you can see that it still shifts up the level a lot, and so that's important. It makes us much closer to the US in the recent years than to continental Europe. And it's also not now more volatile than the income-only series. These kind of trends are also there as you go kind of further up the distribution. So here showing you the income, the realized gains, and the accrued gains series for the top 5,000 people, top 0.01. And again, you can see that the rise is much faster when you account for accrued gains. So, how should we think about all this? Why does it matter? I mean, the first thing is that excluding gains is problematic, even when your sort of concept of what kind of inequality you want is income inequality, because a lot of gains actually reflect repackaged income that's now taken in the form of capital gains because of the fact that they're taxed at a lower rate, but where they're really something we might have otherwise thought of as income. So it's kind of important when we end up excluding these. That's also important because when we look at cross-country comparisons of top shares, we take effectively, typically, fiscal income measures, and the structure of tax systems are quite different across countries. So this kind of, in countries where incomes and gains are taxed at the same rate, you wouldn't see much incentive to switch. And so you wouldn't particularly get huge differences between the income and gain series. And so that's been seen in Spain. Series there, adding in capital gains doesn't really do very much because they're actually taxed at the same rate. Whereas countries like the UK, where they're taxed at kind of very different rates, where you could go from a marginal tax rate of 47% if you're at the top and you have income tax plus national insurance that's statutory on the individual, down to 10% if you're getting entrepreneurs relief. That's obviously a big range, and that's going to lead to a lot of shifting. And that's going to have a big impact on what we get in the cross-country comparisons here. People have thought a bit about income plus gain series before, and there's been this sort of worry that, you know, the income plus gain series is quite volatile. Maybe that's not really what we want. I mean, one thing is, if that volatility reflects actually what people experience, then that might be something we do want to capture. But the other thing is, you know, to the extent that we think of gains as something you kind of have a choice of when you realize, so I choose when I sell some assets, we might want to think about an accrued gain series that says, well, when were those sort of gains effectively, kind of when did they occur rather than when did I realize them? And when you account for accrued gains, you see that the series is no more volatile than the income series. And this is important for tax policy and the recent work that's been going on by the Office for Tax Simplification, because gains being taxed at this lower rate not only creates this kind of shifting that I showed you, but it also means that the tax system is doing a lot less redistribution than we've previously thought, because it's not, people at the top have a lot of gains and we're not effectively taxing those gains. And so the tax system is really not doing anything to redistribute any of those gains. Just very finally, since this is a conference about measurement, I just would come back to the point I raised in the first presentation. You know, capital gains are really one part of what we might think of as irregular income. There's non-taxable gains, such as gains within ISAs, inherited gains, main homes as well. There's also increasing other forms of irregular income that are not from capital gains. So pension lump sums, for example. Now you can take out a quarter of your pension tax-free. That means it's not counted as fiscal income, which obviously can be a lot of money. And the larger your pension is, the more money there is to take out. Similarly, inheritances and gifts, again, we know are weighted towards the top. So our measures of inequality are going to be heavily affected by the fact that we're choosing to exclude these things, and these things we're excluding tend to be weighted towards the top. So it is important for us to think about when we're measuring inequality, when we're talking about inequality, what is it we're trying to capture? And sometimes the answer might be it's hard to capture what we really want, but to be really aware of those issues. And, you know, I think the work the ONS has been doing to try and improve these measures is really important to try and incorporate these kinds of issues and account for the fact that there are these other sources of income that we normally don't capture. Thanks very much.
Thanks very much, Arun, for this final presentation. I just wanted to say briefly that in about 10 minutes, the Zoom will be cut off automatically. So if you have any more questions after that, the conversation can be continued in the conference chat room or by messaging the presenters privately on the platform. But for now, we still have some time to answer some questions in person. So if you have a question, please type it in the Q&A. Please don't forget your name and affiliation. I don't see any questions right now. I will wait a few more seconds. Oh yeah, there's one here from Kanya from Brunel University. Can we?
Yeah, hi, can you hear me? All right, thank you for the presentation. When you showed the distribution charts of the joiners and the leavers and the people that stay, do you actually have like the numbers or like the percentage of the absolute numbers? Because if it is just a small number of people that actually join, then the distribution doesn't actually change the actual distribution of the 1% or whatever. So do you have that? I also have another question, which is probably like, I'm sorry if it's kind of political, but when you say like, you know, when you're talking about, you know, increasing policies to target these gains based on like 0.01%, which is actually about 2,000 people. I guess the concern with these things is that these 2,000 people have a choice about where to go. Typically with, I don't know if I'm making a really political point here, but that these 2,000 people are a very small group of people who can go anywhere, right? I was wondering whether maybe it's worth this kind of analysis looking at like a higher percentage of the top income distribution, so that it's something that's like macro and like an aggregate rather than like such a small amount of people. I don't know if that makes sense. But anyway, yeah, those are my two questions.
No, there's two really important points. So just on the first one, and how many joiners are there to say to the top 1%? So about 1 in 10 people who end up in the new 1% are the joiners effectively.
And how many are, so that means the 90, so that means that 90% stay?
Yes, exactly.
So when you're looking at the distribution in terms of gender and age, it wouldn't actually change the 1% that much.
I mean, you can sort of decide whether you think of that as a big change or not a big change.
Yeah.
What 1 in 10 of the people?
It just gets diluted by.
Yeah, so it gets diluted.
Yeah.
For sure it gets diluted. So you should think about that as there are these other kinds of people who get brought in this case. And so again, it sort of matters when we think about the design of policy and who it's going to impact. Specifically, if you were going to say, for example, think about changing capital gains tax rates, then that's going to have an impact on that specific 1 in 10. So you really want to care about that 1 in 10.
Yeah.
If you're thinking about something that affects the 1% overall, you want to care about the 9 out of 10 who are in the stayers times the 1 out of 10 who are in the joiners. Mm-hmm. In terms of, is this a small group? Is this, should we be doing this? I think there's a few things to say there. So the first is that in terms of the amount of money at stake here, and it doesn't mean we should do it, but the amount of money at stake here, it's something like £12 billion that you could raise on a static estimate if you were to tax capital gains at headline income tax rates. That's from actually a different set of work, but also with the same co-author.
Yeah.
And so that's the kind of the equivalent of putting up the basic rate of income tax by about 2.5 pence,
right.
or increasing the headline rate of income tax by sort of 5. The top two rates, so the 40p and the 45p rate, by about 5 pence each. So it's a sort of a big.
It's not
if you're trying to raise money, that's quite a lot of high impact you'd have to do elsewhere.
It's not that I dispute the amount, it's more that the choices facing them, I'm sure it's huge. I can imagine that it's huge, but it's just that I'm sure that they could easily go somewhere. I think that is always the balancing act that is typically at that top end of the scale. Anyway, sorry, continue.
So okay, let me come to that. So the first is just in terms of money, it's an important thing for us to think about, specifically at this time when we're thinking about raising money. The second is, how movable are these people? So it's not actually clear that these people are completely movable. Actually, so from the work that we've done that Lorenzo is presenting, you see that a lot of people who are at the top are in finance. And finance is an industry that's particularly what we describe as agglomerated, in the sense that London really pays very, very well if you're in finance. It's not really worth staying in Germany or in France to be in finance if you are that kind of high skilled and doing that well, because you do get paid a lot more. And so that's why you see a lot of people moving to London to get those kind of jobs. So it's not immediately clear that these people can move and get the same kinds of pay elsewhere if you're just worried about the 1% more generally. We actually have some work specifically looking at how responsive the top migrants are to taxes, but that's not cleared yet for release.
But they don't have to be migrants, they can be British and move.
Oh yeah, the Brits are even less responsive. No, the Brits are way less responsive. I think we already know the Brits are way less responsive. A combination of language factors and the fact that pay is much higher here means that you don't have any incentive to move if you're British. You have very weak incentives to move if you're British. I mean, essentially, your question is there a place where I get a higher take-home pay that I can use to convert into standard of living in another country than here? And is that going to change substantially when we?
Oh yeah.
So, and the answer is probably not, based on the work we've done. The other part to that is, I think that the kind of concept that this is all about taxing the rich misses the point, in the sense that there are this set of people at the top who have capital gains. But again, there's part of other work that we've done on taxes at the top. There are lots of people at the top who are paying the full headline 47% rate of income tax plus national insurance contributions, and they don't have any. They're not leaving, and two, they're already paying the full rate. So it's actually not even a question about vertical equity of, compare the rich to the poor. It's really even a question about comparing the rich to the other rich, because there are people who have £2 million, they work in a bank and take £2 million in income and have no ability to do anything much with it, so they pay the full 47p rate on it. And someone else who has £2 million in carried interest, which is taxed at 28%, and so gets a much larger amount of money they can take away at the end of the day than the person who's in the bank. So I think that kind of thing matters, and I think it's kind of clear that even from a horizontal standpoint, you're creating distortions
standard-
across. You're creating distortions across different parts of industry in the UK because it creates an incentive to work in PE rather than in banking. You're also creating kind of just inequity at a horizontal level because it's not obvious you should favour the person in private equity over the banker.
All right, the chat will be shut off in I think about 1 minute. So there were no further questions in this chat box. So I let this discussion go on a bit longer. But I would say for now, thank you very much to the presenters for the presentations, for the attendees, for their questions, for listening, and enjoy the rest of the conference, I would say. Okay, I will close my video.